Sales has booked the revenue, finance says it cannot recognise it yet. That sounds like a disagreement, but it may be two teams describing two different moments in the same commercial journey. I'm Gavin Summers, a senior analytics engineer and reporting trust consultant. In episode 2, we'll follow one fictional Brightside Bikes order from booked to collected. Then we'll show exactly when two revenue numbers can both be right and when the gap becomes a reporting trust failure. Let's jump in. Sales has recorded a Brightside partnership order as booked this month. Finance has not yet included the same activity in recognised revenue. Both views can be internally consistent, yet the leadership decision still waits. The meeting stalls because the word revenue is hiding two different clocks. The sales view is organised around the book date. The finance view is governed by the approved recognition period. What is commercial committed and what must the business deliver? What can finance report this period and what cash is actually available? Those are different questions, so they should not inherit one universal revenue answer. To separate them, follow one order through 5 distinct business moments. We'll use Brightside Bikes, a fictional composite, and one partnership order with no headline amount. The example represents a common reporting pattern, not client data or accounting advice. The first moment is booked when the order or contract enters the commercial record. That can signal commercial momentum, but it does not automatically become recognized revenue. Next, delivery happens or the agreed service begins. Operations may use that event to plan capacity, fulfillment, and the work still outstanding. An invoice creates another date and another useful view of the same activity. Credits, partial invoices, and tax treatment can change what that billing view means. Recognized revenue belongs to an approved period under the relevant contract and accounting policy. It supports controlled reporting only when finance can explain the boundary and review. Collection happens when payment arrives, possibly after several of those earlier events. Cash planning cares about payment status, timing failed payments, and currency treatment. The exact order can vary by contract and operating model. So this life cycle is illustrative. One business activity can therefore create several valid dates, states, and decision windows. Now connect each window to the decision it can safely support. A view is not right in isolation, it is right for a defined use. Bookings can help commercial assess commitments, momentum, and the capacity those commitments may consume. That use still needs a booking definition, a cut-off, and clear treatment of cancellations. Delivery or service start evidence helps operations understand what must happen next. A difference from bookings may simply reflect work that has not started or finished. Recognized revenue can support controlled finance and board reporting for the approved period. That view needs its policy, adjustments, caveats, and finance authority attached. Collected cash supports liquidity decisions because it answers whether payment has actually arrived. It should not be substituted for recognized revenue or treated as a more truthful version. The useful question is not which number wins across the entire business. Ask which view is safe for this decision and what context makes it safe. Now compare the sales and finance views without trying to merge them. Start by giving each view a precise name instead of calling both simply revenue. Place the sales view beside its lifecycle event, date field, and commercial decision. Place the finance view beside its recognition period, controlled boundary, and reporting decision. Then expose what each view includes, excludes, and adjusts. Name the owner or authority who can explain and resolve that boundary. When the difference is known, visible, and owned, each view can remain useful. When each is also safe for its decision, the divergence is tolerable. Tolerable does not mean approximately correct, and it does not excuse unexplained gaps. It means the reason for the difference is controlled and appropriate for the use. Now remove the labels, dates, caveats, decisions, and owners, but leave both calculations unchanged. The two cards just say revenue, so the same difference becomes easy to misuse. That is where a legitimate distinction becomes a reporting trust failure. The problem is not difference itself. The problem is difference without usable context. Ask whether the views share the same question, period, and business boundary. Then check whether adjustments are visible and whether authority is clear. If the views answer different questions or periods, the difference may be expected. It still needs visible decisions, boundaries, and owners before anyone can use it safely. If question, period, and boundary match, a remaining difference needs investigation. Trace both figures back through their source, transformations, and manual handoffs. Hidden adjustments need inspection, including what changed, why, who approved it, and how it was checked. The person applying a valid adjustment is not the problem. Hidden logic is, if nobody can resolve the definition, do not ask the analyst to manufacture agreement. Name the decision authority, the reporting custodian, and the source evidence needed for resolution. The evidence should lead to one of two honest outcomes: record an expected, explained difference or an unresolved gap that needs investigation. You can run this test without scoring the whole reporting estate. Choose one sales and finance pair that already consumes meeting time. Write the exact name people use for each view. Then mark the lifecycle event and date field behind each one. Record what each view includes and excludes. Add every manual or controlled adjustment that changes the reported boundary. Name the decision each view supports, not a vague ambition such as better visibility. Finally, name the owner or authority who can resolve disagreement. Compare the rows one at a time. Known differences get an explanation, while missing context stays visible as an open gap. The result should identify the view that is safe for the decision. It should separate expected differences from unresolved gaps that still need investigation. That gives the analyst a bounded investigation instead of a request to force agreement. It gives leaders a reasoned basis for choosing the evidence they will use. At the end of the test, the two views may still show different results. That is acceptable only when their reasons and permitted uses are explicit. Reporting trust does not require one number everywhere. It requires a clear basis for the decision in front of you. Keep the difference known and keep the context visible. Make the permitted use and ownership clear. Then both numbers can be right for their own decisions. Without that context, neither is safe simply because it looks plausible.
So, the next time sales and finance bring different revenue figures, don't begin by forcing a match. Put each view on the life cycle, name its date and boundary, connect it to the decision, and make ownership visible. Read my guide, Revenue Dashboard Does Not Match Finance. What to check first. It's linked below. It gives you the checks to run on one disputed number before you rebuild anything. In episode 3, we'll trace one KPI from its source system to the business decision it supports and shows where meaning can change along the way. See you in the next episode.